Good evening, everybody. This is Mike Hebern from Level Financial Advisors, and I'm joined once again by Apollo Lopescu from DFA. And tonight's going to be a pretty simple presentation. The purpose really is to give an overview of DFA and what value it provides for our clients. So Apollo, who's a vice president at DFA, he started with them in 2004. He has a PhD in economics and finance at the University of California, Santa Barbara. And he's currently affectionately known as Dimensional's Secretary of Explaining Stuff. And in his role, he frequently presents around the country and the world to advisors and clients about what DFA has to offer, among many other topics. So if you haven't had a chance to see his cryptocurrency webinar that we did a few weeks ago, I highly recommend that. You can grab that information on our YouTube channel. So I'm just going to turn it over to Apollo now. Apollo, thanks for joining us again. And I'm going to switch it over to speaker view and let you take it away. Oh, and one other thing for everybody online here is if you have questions, please use the chat feature and I will definitely get them to Apollo so we can answer them live here on the webinar.
Great. Well, first of all, Mike, thank you so much for the invitation to come back, and thanks to everyone for taking the time. I guess the topic tonight is about dimensional fund advisors, also known as DFA, and just a bit of introduction in case you're curious. You might see this on your statements. Who is dimensional? How is it different than other fund families, and then perhaps why haven't I heard of this mutual fund complex? And why is it not a mainstream and not see ads in People Magazine or whatever ads might go these days? To Mike's point, this is a small intimate crowd, and I'd love for this to be a dialogue rather than a monologue. And Mike, perhaps you can monitor the Q&A box and see if there are any questions that are coming up. And I'll try to address them as much as I can. So I won't be able to see the questions, but Mike will be monitoring this and asking them. The more we can make this engaging, I think the better. So Mike, is that fair? Should he start there? And
yeah, absolutely. I have the Q&A box open here. I'm ready for people to put in their questions if they have them, and I will let you know as soon as they come in, and I'll just try to interrupt at the right place, and we'll go from there.
I wish there was a prize for the first question. So
we can get going. Oh, wait, maybe I could probably come up with one. Go ahead. Over to you.
Well, let's start with just a high-level overview. So Dimensional Fund Advisors is an investment company that is registered pretty much like all the other mutual fund companies in the U.S. with the regulatory agencies and the SEC, Securities and Exchange Commission, and also part of what's known as FINRA, which is a self-regulated agency around mutual funds or broker-dealers. And as of about, just call it a year ago, less than a year ago, we also have ETFs, which is a different set of investment vehicles from mutual funds, but still regulated in a very similar fashion. So we are regulated, we are registered pretty much like everybody else in the industry. Much more so than hedge funds. Hedge funds have their own world. We're not a hedge fund. We are a mutual fund company and an ETF company. So in that respect, just a quick vitals, the brief overview. We have been in business since 1981. So this year we celebrated our 40th birthday anniversary. And as of last time I checked, we're roughly about $650 billion in assets under management, which makes us one of the largest investment managers in the country. We have about 1,500 employees. It is a global enterprise. We have offices in Austin. That's where the headquarters are. But then we certainly have offices in North America, in Santa Monica and Vancouver in Canada. We have a European office in London, Berlin, Amsterdam, and Australia and Sydney. We have a Tokyo office. We have a Singapore. So it's a really a global enterprise that we have right now. The reason that Dimensional is not a household name is, and what really sets Dimensional apart is that we wanted to be an institutional money manager. And the strategies that we had from day one really not required, but it would have been really useful to have strategic long-term investors in the funds, because institutions have consultants, and these institutions tend to have a very strategic way of looking at the world because of all the consultants, and they spend a lot of money on having these consultants. They analyze things. And they have a strategic, disciplined approach to investing, for the most part. And what we wanted to do is make sure that when you have funds in which multiple investors put money into, that the actions of any one investors don't negatively impact everybody else. And in the early days, the only clients of Dimensional were these large institutions, endowments, pension funds. And it wasn't until 1989, 1990, when a financial advisor is pretty much like Mike, not as good looking, maybe he was actually, what that advisor did is came to Dimensional and said, the funds that I have would be very nicely complemented by the funds that you have. Could I please use the funds for my own clients? And with the answer that he got is like, no, we work with strategic long-term institutional investors, and we explained the reasons why. Now, it turns out that that advisor, also had that strategic, disciplined approach to investing, and came back and acknowledged to the founders of Dimensional, the understanding of why is it that this is required. But then what he did suggested that perhaps there are other advisors like him who can be treated like institutional consultants, and have that very strategic approach to investing. And for those folks, once there is a mutual due diligence process, perhaps those folks could have access to the mutual funds on behalf of their clients. In other words, not to have direct access of individual investors to the mutual funds, but rather have advisors with whom we had a mutual due diligence process, so they understand what the funds are doing, and we understand how they fit into their strategy. And for this, limited number of advisors, they would be able to use Dimensional funds on behalf of their clients, and for the rest of the advisor universe, not to have access to the funds. So Dimensional is not available to retail investors. Dimensional mutual funds are not available to retail investors directly. They're only available through a network of financial advisors. And what's interesting about the business model is that it mimics Mike's, that we never wanted these advisors to use the funds because Dimensional would compensate them to sell the funds. So we, in the entire history, we have never paid anybody, an advisor, to say, listen, use our funds and you're going to get paid based on that. There are a lot of practices in the industry that might do this. We have never done any of that. So we always thought that advisors should work for their clients and should not have these conflict of interest and have, the exclusive benefit being towards their clients. So even though we have this select network of advisors who are approved to trade Dimensional funds on behalf of their clients, it is not based on financial arrangements. And Mike, you can chime in over the course of the time that we've worked together. You can speak about how much monetary exchanges have taken place between our two companies.
Right, exactly.
And that gives you the ability to choose what do you think it's right for the client rather than what's right for your bottom line. So in that respect, one thing that sets Dimensional apart is just this alignment with certain financial advisors, in their business model as well as in their investment philosophy, and not have retail access to funds. And because of that, I can tell you that you're not going to see advertising in magazines or on websites, because you would be disingenuous. Buy Dimensional funds, but by the way, they're not available to the retail investors. So that's the model that we still have on the mutual fund side. It's pretty much working through these financial advisors. That's the first thing that I believe sets Dimensional apart. The second thing that sets Dimensional apart, in my view, is the fact that from day one, we have tried to tap into a much more scientific, rigorous approach to investing by engaging some of the brightest minds in academia. And looking to see what is the research around investing that is relevant, and can we use some of that research to create real world portfolios for clients. So Dimensional from day one has tapped into this, academic brain power and the scientific approach that it brings with it. And, from the very first day, it was the founder of Dimensional kind of going into the offices at the University of Chicago. That's where he got his advanced degrees. And looking at some professors and asking them to come in and monitor as an investment committee what the funds are doing and make sure that it's very rigorous in that respect. And subsequent to the time when he started, several members on the investment committee and the board of directors actually have been awarded Nobel Prizes in economics. So we do have several board members with Nobel Prize over the years.
So Apollo, real quick, we do have a question that came in.
Yep.
The question is, what investment model do you want to see in a financial advisory firm or in financial advisors that you open DFA to? So in other words, I think the question really is, what are you looking for in a financial advisor before you allow them to use your funds?
That's such a good question. Thanks for asking it. What we're looking for is our advisors who have an investment approach that is not built around short-term forecasting of the markets, because what tends to happen is that those advisors have what's called hot money. In other words, they might put, say, $10 million into a particular fund, thinking that that asset class is going to do very well over the next 6 weeks. And they put the money, so Dimensional has to trade to turn that dollar amount into securities, into stocks. But then a few weeks later, they change their mind and say, no, I don't think it's going to do that well. I think I want to move the money to some other asset class. And at that point, that hot money means that when they redeem, by law, we have to give the cash back to investors within a day. So what a mutual fund has to do is sell and get the cash so we can pass on to investors. And that hot money is really detrimental because it leads to transaction costs and it leads to turnover that is not necessarily in the benefit of everybody else in these commingled funds. So we're looking for an advisor who basically looks and says, I'm going to create an asset allocation and I'm going to be disciplined around the asset allocation. I will make changes. For sure, there'll be changes. But the reason for the changes is because the markets have moved. Or the client's circumstances have moved, rather than I have a forecast and I'm going to move in and out of an entire position. And one of the big benefits of this disciplined approach was actually in 2008, 2009. If you remember the financial crisis, back in those days, when the market, that was the last time that we really saw a dramatic market drop. What was fascinating is that a lot of retail investors without a Dimensional advisor, what they would do is they panicked. And emotionally, they said, I can't handle this anymore. And they would sell their mutual funds. And when they sold their mutual funds, the mutual fund had then, had to go to the market, do a rapid fire sale to generate cash to give it back. And that wasn't the right time to sell when everybody else was dumping stocks. So what we did actually in those days, which is quite remarkable when you look at back at those cash flows, not only that we didn't see over that period, money flowing out of the stock mutual funds, but it was exactly the opposite. What advisors were doing was actually very different. When the stock market dropped and maybe the balance between stocks and bonds in the portfolio had changed, and now there was a lower weight to stocks than the desired allocation, what they were doing is actually buying as the market dropped. So when everybody else is doing their rapid fire sale, what Dimensional advisors were doing were buying, were on the other side of the trade because they were rebalancing. And that system not only benefited the client themselves, because at that point you're not too light on stocks, but it really benefited everybody in these commingled funds because we didn't have this hot money, emotional money that got out of there. So that's really what we're looking for is to be a good client is somebody who does not impact the other shareholders in these mutual funds, and that means that there is an alignment in philosophy, a much more strategic, disciplined approach to investing. So I'm glad you asked that question to clarify. So on the academic side that we're talking about, what we try to bring is much more rigor to investing. This is going back to 1980 or so when we started 1981. And what I mean by that is when we think about investing, so much of it is done based on observation, a hunch, somebody's opinion, and it's really not based as much on data, particularly when you look back at the 1980s and the 90s. It was a hunch. It wasn't really driven by analytics and rigorous science. And what we try to do is, to some degree, be the Moneyball for investing. If you remember the movie Moneyball, Brad Pitt was the manager of the A's, and what he tried to do is bring some data and evidence, and not really look for certainty and guarantees, but look at the odds and say, what would give me the best chance to win. And it turns out that looking at the data was something useful, and now pretty much everybody is doing it. And we try to do, conceptually in that sense, something similar back in the 1980s, working with these academics. And we do have all the strategies right now. They are really, looked at, and anything that we try to do different in the funds, it has to go through the investment committee, has to do through the board to make sure that what we do is absolutely rigorous and it's backed up by data. It's just very different than the regular business model of many investment companies. And the third,
I'm going to jump in with a quick question real quick. Sorry, I saw another question coming in. So the question really was, is DFA particularly conscious of investment bubbles, and do they seek to avoid them in any way?
Yeah, so we are looking at bubbles. And by the way, bubbles can be defined in many ways, and I'm not sure there's a one single definition of bubbles and what exactly a bubble is. You're talking about, I think in a loose sense, a lot of folks are saying, well, when you have the price that is very disconnected from what the fundamentals of the company might be. So we absolutely are paying attention to the bubbles. And a lot of this is done through a very systematic process that's already built into the strategy of the funds. So talk about a bubble again. We don't really think that we know what a bubble is and what's going to burst. There's no clear definition, but just in the sense of just creating some perspective around the question and putting some color. You take a stock, for example, like some GameStop or AMC, and you look at the fundamentals of what is the company generating in revenue, what are the profits and the expected profits, what the industry, all these analytics that investors might look at, and then you compare those with what is the price per share. And sometimes it could be there is a disconnect between the intrinsic value of the company when you make some, when you have some expectations about the future earnings or the future cash flows of the company versus what is worth today. So in some of those cases, we absolutely look at some of these companies, and one of the metrics that we use in our investment strategies is profitability. And to the degree that a company is, highly unprofitable, particularly the smaller companies, we do tend to avoid that. But what we do is not look at the market as a whole, but rather try to look at individual companies based on a systematic set of metrics, and then let those metrics trigger at some point some decisions, and then a portfolio manager reviews those triggers and decides whether or not we should take action. So to answer your question, we do pay attention to companies, individual companies, much more so than we pay attention to the market as a whole. Because it's harder to define what a bubble is. And in our investment view, because the markets are so competitive, it's really impossible to say that even if prices are high at the market level, how long can they stay high? And there's no decision rule that could we apply. We've looked at that and there's nothing there. But on the other hand, we actually do look at the individual companies and figure out in what part of the market they are. And small companies that are highly unprofitable, for example, those companies we do tend to exclude. We just don't use the word bubble. It's not something that it's in our vocabulary.
Okay. A couple more questions. So the questions are definitely rolling in here. So this question first is, do you loan securities out to others?
Yes.
Is the question.
Yeah. So what is that all about? So let's explain a little bit of the concept that the question is getting to. When you are a mutual fund, you buy stocks on behalf of all the shareholders who had put money into the funds. And that stock position is in your possession. It's yours because you bought it. Now, it turns out that some investors might decide that stock is something that, let's say, might go down in value. And they just say, I do believe that stock is not worth as much and it might go down in value. Now, how would you profit? How would you actually make money from that belief? Well, one of the things that you can do is you can come to a company like Dimensional that has these stocks, and you can come to this company and say, well, you know what, I actually would like to borrow that stock from you. And here, I'm going to give you the value of the stock. So let's say just for illustration purposes, that stock is $10. So you give Dimensional the $10, and then you take that stock and you sell it in the market, and you sell it right away, and you realize the revenue you bring in $10. Now, as the stock drops, if you're right, then you can buy it later, perhaps at $8, return it back to the mutual fund, and pocket that $2 difference because the stock dropped. So a lot of times the securities lending is a way to do something called shorting stocks. So shorting stocks is exactly this process that I described. And when that happens, so Dimensional in that respect is saying, well, if you want to short the stock, if you want to borrow that position, it's fine with us. But there are a couple of agents in between us and the ultimate borrower to make sure that we don't stand to lose in case that person gets really burned. So what they do is they give us the cash. And that cash always adjusts to what is the value of the stock. So if the value of the stock went from $10 to $12, then they have to add another $2. So we always have to have the collateral in cash. Now, why would anybody want to do this? Why would you lend these securities out? Well, there are two reasons why you want to do this. Number one is that on that security that they borrowed, this is not free. In fact, you have to pay a fee. You have to pay for the service of lending that. Otherwise, why would I do it? So the mutual fund, in fact, can realize some revenue from lending these securities. And by the way, this is not trivial revenue. Particularly the stocks that are not easy to borrow, you can actually get some really good revenue. And in the fund documents for different funds on the website, you can see the level of revenue that the fund can generate from this activity. So you want to do this because you want to actually generate revenue. Now, what's interesting about Dimensional is that when this revenue comes in, we're not taking it ourselves. We actually put it back into the fund because it belongs to the shareholders. Minus whatever we have to pay the intermediaries. But pretty much outside of that, it is back to shareholders rather than being kept by Dimensional. Not all funds, families are the same, but we believe that that's a value add, and that's the shareholders' money. So the first reason is that you collect revenue, and it could be very meaningful. On the website, and I'd be happy to follow up with Mike and the team to send you some of these documents of how remarkable the securities lending revenue can be. The second reason you want to do this is because when you are being given that cash, you could actually invest that cash in very, very safe overnight securities and actually generate, once again, some revenue for the fund. So in that respect, it's something that the cash is being put to work. And yet, when you think of the, is there risk involved in this? Well, we use overnight, investments, but also what's interesting is that there are two other intermediaries that are really protecting to make sure that we don't get burned. So securities, the biggest, listen, it's a really good way for investors, for a manager like Dimensional, to add value, because this revenue goes back into the fund. So yes, we do lend securities, and each fund has a different level of revenue that it generates based on the type of stocks that it holds. If you're looking for the large companies that like McDonald's or Coca-Cola, Apple, Google, that everybody's borrowing, and they're very widely available, you might not generate as much revenue as some of the smaller stocks that are not as easy to find. So, not just in the US, but pretty much around the world. So it is an interesting value proposition that we have.
Okay, next question. How sensitive are you to political developments in your investment strategy, especially in the US at the national level? So I guess, how does DFA factor in political climate in countries, specifically the US, into their decision making?
Yeah. So what we strongly believe, I mean, first of all, politics is certainly a variable that impacts all of us at the individual level, company level. Look at the Tax Act from a couple of years ago, a few years ago. I mean, all of us got impacted in a good way or not necessarily a good way. So, all of this impacts us. The question is, what do we do about it? Is it something that we can control, or is it something that we would incorporate in our decision process? And what we found is that all of us can have a particular opinion on politics, and yet we didn't find that politics really is the primary variable when it comes to the market. So it's something that certainly impacts the market, but I would not call it a primary variable. And I think a lot of folks, particularly after the election last year, were asking questions about, look, what about, does it matter that we now have a unified democratic government control? How much does it matter when it comes to investing and the markets? And are you paying attention to this? So we did look at some data about times when the government is under the same party control. And we certainly have the Democrats now, but you can look back and find times when the Republicans actually had this unified government control, when they controlled the presidency, the White House, the Senate, and the House. And going back to 1920s, when we have good data, they had this for 13 years. And during the time of these 13 years, when they controlled these three branches, the average return in the market was 14.52. So certainly, the Republicans had a nice return in the market on the Republican side. And we wanted to know, well, what about the Democrats? Did they have the same thing? And it turns out the Democrats also had this unified government control with the White House, the Senate, and the House, but it wasn't for 13 years. It was for a lot longer, 34 years. So the question is, how did the market do? And is there a thesis that we can come up with looking at some of this data? And what we found is that we ran this number over and over. What we found is that over this democratic unified government control, the average market return was 14.52%. It is identical to the second decimal. In other words, as much as we believe, and the media is kind of making us believe that the market is so dependent on the politics in Washington, when you look at the data, when you look at the evidence, what it tends to suggest that, whether we have Republicans or Democrats, that is certainly a variable, but it doesn't seem to be driving the stock market. So in that respect, what we believe a lot more is that the market is taking account every single minute of the political developments. And we want to let the market kind of tell us, what is it that this policy will impact either company or sector. And then what we found in the research is that the price tends to adjust extremely quickly. So we're not in the business of trying to forecast. We believe it's a variable among many, but it's not a primary variable. And in terms of how it actually impacts the market, we do believe that, or an individual stock, we do believe that all the participants, all these investors around the world are very quick to incorporate any new development into a valuation of a company.
Okay, so this is just a quick follow-up question on this one is that, he says here, it sounds like DFA does not donate money to political parties to encourage a certain type of economic policy coming out of Washington. I'm assuming.
No, I mean, we're
right,
listen, I mean,
exactly.
we're a microcosm of the country. I mean, you got people all over the place, but I mean, I think the good news is that within Dimensional, it's an incredibly civil, and I mean, there are people who might believe in others. I can't say that every single person at Dimensional believes in the same philosophy, the same candidate when it comes to politics. When it comes to investing, I'm pretty sure they're all on the same page. When it comes to politics, we're all over the place. But then, that's kind of the beauty of the country. It shouldn't be that uniform, and you should be able to have a dialogue. I mean, I love my coworkers regardless of how they voted and what they believe in. So no, we don't donate as a company to anyone. As far as I know, we're a private company, and generally speaking, because we're a private company, I think that from day one is just, listen, let's just go ahead and create the solutions. And if you as an individual want to participate in the political process, that's on you. That's as an individual rather than that as a company.
Okay, another question coming in here. So we're getting some good questions here. The next question is, are there certain market conditions that create challenges to the success of your investment model?
I wouldn't say there are challenges to the investment model. I think, if I can rephrase it, there are challenges around making sure that everybody understands and manage the expectations. I think that those are the market conditions that tend to do the most. I can tell you right now that when the market dropped back in 08 or first quarter of 2020, I felt like this is the time when we earn our keep. And that's when advisors earn their keep, by making sure that clients are disciplined. So I'm not looking at a market downturn as a negative. A lot of times I look at it as an opportunity. It's an opportunity to buy at better valuation. But the challenge comes from a different direction. It's not, I wouldn't say it's a challenge, but something that has been interesting to us. And here's what it is. The way that we see the investment process, it's not necessarily about looking at individual stocks. So if this is if this square is the entire stock market and all the stocks fit in this box, one model is to cherry pick a handful of stocks and then leave out everything else. And we don't think that this is state of the art, because the markets are too competitive. Information flows too fast. By the way, there are more professionally managed mutual funds than actual stocks trading on the market. So it's too competitive to believe that individual stock research actually can add value. So what we do in the research that we do, perhaps does have these stocks, unless they're like the small, unprofitable ones. But we also want to understand and capture the behavior, not of any one stock, but rather of a basket of stocks, or groups of stocks, something we know as asset class investing. So that's kind of what we're trying to do, is do the research. And this is what computers and data have allowed us to do at a much larger scale than individual companies. So where's the challenge in this? Well, when we did this research, what we found is that you can break out the market into different asset classes, different parts. And one of the first ones to emerge back in the late 70s, early 80s, was this idea that the large, well-established, mature companies, something that's called large cap, that's what you would see in the Dow Jones Industrial or the S&P 500, they tend to behave differently than some other smaller companies called small cap, which are still part of the U.S. market, but they are not in the S&P. So for example, there's a Pfizer vaccine, and that's part of the S&P, but there's also a Moderna, which is a smaller company stock. There's a Shake Shack, which is a smaller company, but we also have McDonald's. So there are all these companies that are publicly traded, and some are the S&P and they're large, and some are not, and they are part of the market in this small cap universe. And what we found is that, looking at economic intuition and looking at the data, that they do behave differently. And we have this book that I know Mike is very familiar with, that is called the Matrix book. And what the Matrix book basically is the big book of investment numbers. It's the most beautiful investment book that I've ever seen. It's just all full of numbers. And what that allows you to do is really see from a data perspective how have small cap stocks behave different than large cap stocks. So one thing that we see in the data is going back to the 1920s, since we have good data. If you look at $1 invested in the S&P 500 index in the US from the Matrix book, these are numbers from the Matrix book, that $1 to the end of last year would have grown to about $10,000. It's 10,900, but just say $10,000. That's the growth of a single dollar over this entire time period. By the way, this is exactly my dad's lifetime. My dad is just turned 95 on Friday. In his lifetime, $1 invested in the S&P would have grown to about 10,000. So I wish my grandparents had put $100 in there. But here's the thing. The other thing that he could have done with that dollar is not invested in these large, mature, well-established companies, but he could have put it into the small cap universe. And these are companies that are not in the S&P because they're smaller. And if you look at the growth of the same dollar over the same time period in the Matrix book, in the dimensional small cap index, what you see is that the same dollar would have grown to roughly about $36,000. So significantly bigger growth in small companies than in large. So at this point, you say, well, you can put the money in the S&P, but if you pay attention to small cap, that might not be that unwise. And in the late 80s and early 90s, the question was, what about all the large and what about all the small? Are they exactly the same? And the answer was, well, you can further delineate and you can look at the price relative to a company fundamental, like earnings or dividends or cash flows. We use book value, and the low price stocks, they're called value companies, value stocks. Over the long run, they tend to outperform the more expensive counterparts called growth. So knowing that value over the long run outperforms growth, small beats value, the one asset class, the one part of the market that ought to give investors the biggest bang for the buck is that has both small and value. And from the Matrix book, if you look at the dimensional small cap value index, the same dollar over the same time period would have had a different growth of about $90,000. So significantly greater growth in small and value. Now, what's the challenge? Because you keep saying this is all nice and dandy, but what's the challenge? Well, the challenge is that when somebody sees numbers like this, when somebody looks at this, investment universe, first of all, they might say, why not put all the money in small value? Or what's the risk? And to me, the challenge becomes conveying to folks that this system of investing, it's really not about certainty or guarantees. In other words, there's no way that anybody can tell you that every day small is going to beat large or value is going to beat growth. I expect that's going to happen, but it doesn't have to be every day. If you go to Vail or Aspen in January, your expectation is to see snow on the ground. That's fine. I expect that every January. Now, if you show up any one January, you might not see snow. It's a bummer, but that the expectation hasn't changed. It's just conveying this, that at times when small companies don't outperform, when value doesn't outperform, that doesn't mean that the system is broken. That's just exactly what the data shows. And when I mean what the data shows, it's quite interesting. If you look at the historical data around a small company and then value, particularly, this is what you see. On a one-year basis, about 59% of the time, value is outperforming growth. So value beats growth on a one-year basis. What that means, in other words, is that almost 4 in 10 years, growth is beating value. It doesn't happen every year. Absolutely doesn't happen every year. And the years when it doesn't happen, a lot of investors might be disappointed and say, boy, you know what? This is not working out. But we know that 40%, 41% of the time, that's not going to be the case. And even if you give the strategy more time and you go to 5 years, your odds improve. Now it's 72% of the time. But even after 5 years, boy, you're going to be disappointed. Roughly, 28% of the time, it's not there. And even after 5 years, you're going to say, listen, do I want to stick with this? And the answer is, listen, if you saw these odds, which part of the market would you like to emphasize? It's absolutely possible that we're going to go through one of those periods when growth outperforms even after 5 years. But that's not unusual. That's not unprecedented. It's just a matter of looking at the data. And even if you go to 10 years and you say, I'm going to give it 10 years, your odds improve once again, but it doesn't become 100% of the time. In other words, the longer you give the strategy time to work, the better your odds. But even after 10 years, it's not 100% of the time. The challenge comes, Mike, is when you have a period of 5 years, which we know that more than 1 in 4 periods, the value will underperform. Sometimes the challenge is for advisors to make sure that the clients don't abandon the strategy just because it didn't work out in the short run. And that to me is the big challenge. Is in market conditions when these premiums don't show up, premiums being the difference between value and growth, or small and large, when this is, when value doesn't outperform, sometimes it could be challenging for an investor to stick with the program. And one of the ways that we resolve this challenge, and advisors do it, is by not plopping all the money into small and value, but basically having a more balanced allocation where they do have some large, when they do have some growth, and it becomes more of an idea of emphasizing different parts of the market like small and value, rather than putting all the money into an asset class. But to me, this is more of a behavioral aspect of investing rather than necessarily an investment challenge. And an advisor put it very nicely once: I don't have people with investment problems. I have investments with people problems. And I thought there was a pretty interesting way to put it.
That's a good one. All right, a couple more questions here rolling in. Can you speak to Dimensional's approach to bond funds?
Yeah, we just had a session today, a very lengthy session on the bond funds. So on the bond funds, there are some really important similarities with the stock portion, that we do believe that markets do a good job, and markets being so competitive, they are taking account every day of what the Fed is doing, what the stimulus package looks like, what the shipping, all these things are being put in, the unemployment, all of these numbers are pretty much put in the bond market as efficiently as they are in the stock market. On the bond market, what we think is that it's a different asset class. You should be treated differently than stocks, and in a good way, because bonds tend to be different than stocks. So how are bonds different than stocks? Well, the first thing is that bonds and stocks have a structural difference. Stocks are about ownership. You own a piece of the company, and that entitles you to part of the profits that the company makes. Profits fluctuate, so does the stock market. So just to kind of give you a sense of that, if you look at the S&P 500 over the long run, I told you it's about a 9-10% average annualized return. That's the average annualized return. I don't believe that the market has ever reached and has never actually delivered the actual annualized return in any one year. It looks more like a roller coaster, but it's a very rewarding ride. As I kind of pointed out, $1 would have grown to more than $10,000. So when it comes to stocks, we do think that the role of stocks is much more about delivering the growth in a portfolio. The way we look at bonds is trying to understand, what is the role of bonds? Why would anybody want to put bonds in there when the stocks are doing so well? And one of the goals is to somehow have a backstop, mitigate at times when market drop, the hit that a portfolio takes. And we do that because bonds are not a form of ownership, but lending. As a bond owner, you're lending your money to corporations and the government. And there's a contract that specifies an interest rate for how long you get that interest rate, and then you get your principal at the back end. And if you look at one of the bonds that's considered some of the safest in the market, it's issued by the U.S. government for 30 days. You give them the money. After 30 days, you get your money back. And since the 1920s, there has never been a single negative calendar year in the stock market. So we do think that in that respect, it is a stabilizing force for the value of the portfolio. And you've also stayed ahead of inflation with an average annualized return of about 3-4%. So we look at bonds as a different asset class that has its own characteristics. And the way we approach it is really trying to understand what are the different types of bonds in the market, and make sure that we deliver the funds that are very specific to several characteristics of bonds. So the bonds are there more for stability, we believe, and we have to pay attention to the different types of bonds. And one of the characteristics of a bond, the way we look at it, is to pay attention to the credit quality of the issuer. When you look at the U.S. government, everybody knows it's solid and robust. And if you wanted to lend them the money for 10 years, as a lender, you'd be okay with a particular interest rate. As a borrower, they're fine with that. And that's what the market yield basically tells you, the yield to maturity. That's what it tells you. So if you look, if you look at a 10-year bond, that 10-year bond would pay investors not too long ago about 1.4%, not vastly different today. But the way we look at bond investing, the U.S. government is not the only place where you can put your money. The other place you can put your money is perhaps in a corporate bond. So, the U.S. government is not the only entity that would like to borrow money. You know who else wants to? Amazon. And Amazon would love to pay 1.4%, but the market's looking and saying, you're not as credit worthy as the U.S. government. As large as you are, you don't have the same credit worthiness. So one of the first delineations that we look at is what is the credit worthiness of a company. And beyond that, Coca-Cola, you look, it's 2.5. So the market signal is that in order to borrow money, you have to pay a little bit more. Ford has to pay even more, even though they love to pay less. Other countries want to borrow, like Turkey, and they're paying even more. And then beyond that, you can get a Macy's bond that pays 7%. So one of the things that we do when we look at bonds is really try to understand for each bond fund, what type of bonds is somebody looking to buy? And in some cases, some investors are looking, I just want the very, very high quality. Some might say, I'm okay to be somewhere in the middle. And some might say, I want to be on the right-hand side there. And then they're all perfectly legitimate reasons. But we want to give investors very precise bond funds that don't take too much risk if they don't desire that. On the other hand, if they want to pick up an extra yield, an interest rate, then we can deliver that in a very systematic way. So that's the first thing that I would say is looking at the bond and looking at the bond credit quality of the issuer. The second thing we look at is when do you get your money back? And in that respect, there are some short-term bonds, generally speaking, 1 to 5 years. There are some intermediate bonds and some long-term bonds. And we pay attention to that from an investment perspective because we want to be, once again, precise. They all have different risk-return characteristics. If you look at these are index numbers, but if you look at bonds that are in the 1 to 5 years, and over the period of 1990 to the end of last year, you ask for this 31-year period, how often do I see bonds in the 1 to 5 year range losing value in any calendar year? Well, it only happened to the 1 to 5 year. One time in 1994 when somebody would have lost about 0.7%. That's in 31 years. There was 1 year when he had a negative outcome. If you look at intermediate bonds, they're 2 years, but also in 94, the drop was a little bit greater, nothing horrific, but still a little bit more if you move into intermediate bonds. And then if you look at long-term bonds, not only that he had a lot more negative years, but again, the magnitude of the drop in 94 was significantly more. So as a manager, we also want to pay attention to what is not only the credit quality of the issuer, but what type of bonds are we buying? Are they short-term? Are they intermediate? Or are they long? And we want to give these to advisors in a very precise way. So when they build an allocation for you, it can be really tailored to your needs, your preferences, and your risk capacity. So that's what we do. And the last thing that I will say is that we also have a very global perspective, that we really buy bonds around the world, and we try to have outperformance and increase returns, not by forecasting interest rates, but having a set of activities around selling bonds before they mature. The way you make money in bonds is not just by waiting for the interest payments, but what if you sell that bond before it matures and you realize a capital gain? Well, you can make money that way. So we look at various ways that we can control, and they're systematic, to actually outperform and have increased expected returns, while also controlling the risk in bonds. A very unique strategy that really is about being systematic and precise, very precise, so we don't surprise advisors. Investors want to know what's in their bonds, because a lot of folks got surprised in 08, 09 when they saw, wow, I didn't know I had that. And quite often when people are saying, wow, I'm looking at a bond fund and it has a yield of about 4%, let's buy that fund. Well, the trick is that that 4% might come from, Turkish bonds or having Macy's in there, which might not be exactly what you desire. So we want to be very systematic and very precise and transparent to make sure that we give advisors the right bond funds.
Okay, great. Another question here. This one says, because market trends gradually change over a long period, like the climate, how do you anticipate the direction of future growth for any given asset class? Is there an algorithm or a formula for this issue, or is the solution to balance in response rather than in anticipation?
So there are two issues from what I've heard in the question that I wish I had the luxury of kind of sitting down and kind of understanding the question a little bit better. But my understanding is that a part of it had to do with sustainability investing. And the other one is following some of these trends and seeing if they're worthwhile pursuing. Mike, do you think I got that right, or was there a different direction that I should go in?
Yeah, it's hard to see here and translate. I'm reading it again to myself here. And, what we may be able to do is actually, here's what I'm going to do. I'm going to open up the audio here so that, Tim, if you'd like, you can ask the question here. So hold on one second. Tim, did you want to see if you ask that question more directly? Let's see. Maybe not.
Well, let me try to answer the emerging trend question. I think that's what's interesting about the emerging trend question, is that a lot of investors are following the trends and they're paying attention. And what we observe in the market is that when a trend emerges and a lot of people believe that it has legs and it's going to end up having a significant economic impact, what we see is that investors start bidding up the prices for that company that is in that trend. And a good example of that is you look at electric cars, and everybody kind of is clamoring over electric cars, and it's like that's the future. And when electric car companies come to market and they become public, you see a lot of investors getting very excited about that prospect. So what happens when you see all these investors kind of going and trying to buy, a lot of times that increase in demand it is pushing up the price. So what we see a lot of the emerging trends is that the market is quick to reflect the potential opportunity. So if the opportunity is real, then you're going to see some of these prices being bid up. On the other hand, there's also some short-term time pressure on some of these new companies with new trends. And one of the things that we do is we don't buy companies that it just came on the market for the first year, irrespective of what they are. So we wait a year before we participate into these trends, because we do think that it could create a lot of risk, because some of these might be hot air. You saw what happened to some of these electric car companies that went public, and then soon after, when they started disclosing, it was like either the fraud or things didn't work out the way they were supposed to, and you saw them deflating really quickly. So we are trying to pay attention to trends, but we also want to make sure we don't get caught into a frenzy, and we want to be patient. Our goal is not to change anybody's wealth status, to make you a lot of money irrespective of risk. Our goal is to be responsible in the way we handle the assets and make sure that you are diversified, that you're not overly exposed to any one particular trend that might or might not pan out. That's not necessarily our goal. When it comes to, yeah.
Keep going if you want. I have Tim was able to unmute his microphone here. Tim, did that answer your question, or did you have a follow-up to that?
Yes, and can you hear me okay now?
Great.
Absolutely. Yes, we can.
Yes. So Apollo, that was a very clear answer. Thank you. The reference to the climate was just simply an analogy. I did have a question about the climate, but that was just analogizing. Climate changes over time. I was wondering if DFA thinks asset classes and their trends change over time. You would use the example of greater return on value than on, what was it, big
growth
company stock?
Yeah.
And I'm assuming that that's a perennial trend that will never change.
Yeah,
yeah, and so the question was, if it did slowly change over time and reverse position with the other asset class, would you just have to be responding to that change, or could you anticipate it?
Yeah, it's a great question. So first of all, why is it that we believe that this is going to continue? Small outperforming large. And there are two different explanations that exist out there. One is that the market somehow got this wrong. And so there was, something, eventually is going to give, and this might not last for a long time. And in that view of the world, it might not last forever. That's not what we believe. The second view of the world in which we subscribe is that when it comes to investing, and particularly these very sophisticated investors, quite often a lot of what you receive is a compensation for risk. And when you look at some of these companies, and let's take a small companies relative to a large companies, why do I expect intuitively from an economic perspective for that to continue? Well, if you think of a McDonald's versus Shake Shack, McDonald's is a well-established company. It's very mature, has a lot of systems in place, it has a track record. And you compare that to Shake Shack, well, it's still proving itself. So if I'm an investor and I have an option to put money into these companies, and they pay me, for example, the same return, so my money will grow the same rate between Shake Shack and McDonald's, well, where would I put my money? Realistically, why would I give it to Shake Shack, which doesn't have the track record, is not proven? I would just give it to McDonald's because it grows at the same rate. So then why would anybody give money? Why would any investor invest in these smaller companies? Well, I need to be compensated. I need to have a higher expected return on my money. And then I'm willing to invest in the smaller companies. And that's the economic reason that we think this will persist, even though it might not show every day. The smaller companies might take a bigger beating at some point in an economic cycle. That's fine. But we do think that the fundamental premise is there in the market.
Right. No, that's good. If I may I just ask one quick follow-up to that?
Absolutely. Yes.
Is there any possibility, my question is really getting at the possibility of the plutocrats who own 99% of the wealth, like Google, monopolizing and keeping small value companies on the sidelines so they never grow?
Yeah, that's a really good question. Is it possible that they're monopolizing? I think there are certain sectors that Google, a company like Google, might impact whether directly in terms of being anti-competitive or the prices they charge. What I think is that the market is looking at this. All these investors around the world, they're looking at these companies, and to the degree that Google is that 800-pound gorilla that's going to pound on them, and they're not going to be able to grow, or they're constrained by what Google's doing. Those particular companies will actually already been adjusted in price to reflect this competitive nature relative to Google. So I would say that that's already priced in if for some of these companies. But again, Google is a pretty interesting animal, because what they do is they have to rely on helping small businesses, because a lot of the money that they make is from small businesses. If they start hurting a lot of these small businesses, their own business might be in peril. So that's one way to look at it. The other one is that there is more and more scrutiny on the big tech. And again, I'm not an expert in what's going on in Capitol Hill, but I can tell you that a few months ago, there were the heads of the four families who showed up, and they were in front of a Senate committee answering questions. So I think that they're to the degree that these are anti-competitive, there's going to be more scrutiny on them. But I also have to think that Google, if it's trying to clamp down too much and take too much from these small companies, then they're going to end up hurting themselves. I just don't know at this point how many companies are in direct competition with Google to say, well, you're going to get hurt by that. My guess is that if those companies were there and they were in direct competition, the market would have already kind of said, yeah, I'm not sure you're worth that much.
Okay, I do have one other participant with a hand up, and I want to be conscious of time, so we'll take this as a last question. So, Dave, I'm going to turn on your permission to speak. I tried to chat you. I don't know if you are still interested in asking the question, so give you a quick second here to chime in. Let's see, I'm just kind of checking the score here. It looks like no activity. All right, so what I'm going to do then is I want to give Paulo, you a chance to kind of wrap up anything that you think was important that perhaps we should have touched on and didn't get a chance to, because we had so many great questions. And then what I'll do is I'll say to everybody else that if you do have other questions that you wanted to ask, or maybe felt more comfortable asking separately, if you send those questions to the email address I put in the chat, which is invest@levelfa.com, I'll make sure someone gets back to you with the answers. But Apollo, any final thoughts or comments or things that we wanted to talk about before we jump off?
Well, first of all, I really enjoy the conversation, much more so than ever presenting. So thank you for the questions, and thank you for spending the time with us this afternoon. And I think my only comments are really about the relationship with Mike and Level FA, because thank you for the trust and the partnership over the years, and we're extremely excited to have found a firm like Level that has this alignment and philosophy, and we're grateful to all of you, the folks on the line who have trusted your savings with Dimensional. We are really conscious that we are dealing with your life savings and your family's assets, and every single day we are thanking you and expressing our gratitude, and also letting you know that we are hard at work every day. Through this whole pandemic, we have been actively participating in the market. We've been really trying to support you and the advisors. So thank you for your trust, your partnership, and I look forward to continuing this dialogue. It's been super fun.
All right, well, great. I just want to say thanks to everybody who jumped on, and we'll be making this available, of course, like we normally do with our webinars. So until then, everybody have a great evening, and thanks again for joining us. Take care.